morning students or good morning learners again. I welcome everyone in this session. The today's session is the stock exchanges of India. We will have an overview of this particular stock exchanges of India. So let's start with the topic. So stock exchanges are the heart of the country's capital market, and we know that it plays a prominent role in mobilization of capital for businesses while offering investment opportunities to the persons or the individuals or the institutions who want to invest their extra money or the excess funds in the share markets. Okay. So, India's stock market ecosystem is actually comprised of the vast and dynamic, or we can say at the core of this system there are two primary stock markets. And these stock markets or stock exchanges are Bombay Stock Exchange, which is commonly known as BSE, and the another one is National Stock Exchange, and which is known as NSE. So both are these markets, and together these markets form one of the largest and fastest growing markets globally. Okay. So these are the two markets of the India. Now, as of December 2024, these combined markets, that is NSC and BSC, so the market capitalization of these two markets combinedly stands at impressive, that is 4.6 trillion US dollars. Now, India boasts over 120 million demat accounts. It is a great deal, indicating the deepening penetration of equity investing among the Indian population. That means we can say that these figures tells that the Indian markets are moving towards, or the Indian customers or the Indian investors are moving towards the share markets. So, in addition to equity, India also hosts the multi-commodity exchange. Multi-commodity exchange is commonly known as MCX, which is actually dedicated to trading commodities like gold, oil, silver and agriculture products. And there are so many products which can be traded on this platform of MCX. So, as we know that the key players of Indian stock markets are BSE, that is Bombay Stock Exchange. So, let us have some knowledge about this particular stock. So, and firstly we will explore this Bombay Stock Exchange, which is the oldest in these two, BSE and NSE. The BSE, the oldest stock exchange in Asia, which have been established in the year 1875 with a rich legacy of nearly 150 years. So, BSE has played a foundational role in the evolution of Indian financial markets. So, that is what about the BSE, that is Bombay Stock Exchange. Okay. It is the oldest one. Now, its benchmark index, we see that the every particular market is having its own index. So, its benchmark index are S&P, that is BSE Sensex, which tracks the performance of top largest 30 companies and most actively traded companies on the stock exchange. So, Sensex is the price sentiment of the average 30 companies which are actually in the market. Now, the days of today, more than 5,000 companies are listed on BSE, which is making it one of the largest in the world by number of listing in BSE. Okay. So, it is the one of the largest size of the companies which are listed in the stock markets. As far as data is concerned, so December 2024, as of December 2024, the BSE market capitalization is approximately 3.1 trillion US dollars. That is what a great figure. Now, one of BSE key area of focus in Recent years, they also allowed SMEs, that is small medium enterprises listing, which encourages the small and medium enterprise to raise capitals through these security markets or the share markets, and promoting the financial inclusion by enabling access to capital for undeserved sectors. So, that means what? The BSC is taking an initiative for the SME sector also to raise the money from the this particular markets for the companies. The second one after BSC, that is known as NSE, and the full form of NSE is National Stock Exchange. Now let us move to the National Stock Exchange, which was founded in the year 1992, and it brought a revolutionary change to India's capital market. What were the revolutionary changes or how it worked? So, by being the first dematerialized exchange, paving the way for dematerialization or electronic trading. So, that means in 1992 NSC was the market which launched, and the concept of dematerialization and electronic trading take place in this particular market, which is a revolutionary actually in the trading sectors of shares. NSC's benchmark is Nifty. As we told that the BSC's benchmark is the Sensex. So, NSC's is Nifty. It comprises of 50 companies which represent the top large capital companies across diverse sectors of the economies. So, in NSC more than 2000 companies are listed. So, the NSC has grown rapidly and today boasts a market capitalization of approx 3.3 trillion US dollars. This data is as of December 2024. So, the NSC is also India's leading exchange for derivative trading. What is derivative trading? Actually, derivative trading is the trading of the products which are derived from the basic products of the shares, debentures, and offers futures and options on a wide array of instruments, from indices and equities to interest rate and commodities. That means this market provides the area for option and future tradings, and derivative market is also there. Now let us talk about the some performance of market in the year 2023, 24, and now also we can see the performance of the market. So let us now take a look at how the market performed in this particular year. So, India's stock market performed in recent year, and the performance in the recent year was especially in the year of 2023 and 2024 was good one. Okay. How it is good one? How we can say it is a good one? So, let us see. Both Sensex and Nifty, Sensex that is comprises of 30 shares and Nifty that comprises of 50 shares, reaches the recorded highs in the 2024, which reflects the strong investor confidence and robust corporate earnings. Okay. That is why we can say it was a good year for the markets. In the year 2023, the Sensex delivered a return of approximately 20%, while the Nifty 50 returned, or what we can say, provided the return of approx 19% to the investors who invested in this particular year. So, it is the more than, and in an average 19.5% as we talk about the both the markets. It is a major thing, because we can see that in the Indian market the majorly bank offers not more than 7%, and these markets are offering approx 18 to 20% return. So, one way of the key drivers of this growth was foreign institutional investments, that is FII. So, in 2023 alone, FII inflows were estimated around 1.7 lakh crores or roughly 20 billion US dollars. And this inflow of the funds indicates a positive sentiment towards India's economic and corporate fundamentals. Okay. So, what is the trading mechanism? We also talk about the trading mechanism in the last lecture also. So, in this we will talk about the trading mechanism in detail. Now, let us understand how the trading takes place in this particular markets. So, as we know that the trading starts when you place the order. For placing the order, you need to have a demat account, bank account and the order book also. Now, these things, physical things are converted into the electric one, and you can place the orders through the apps of the brokers. There are various brokers which provides this such type of services of order placing. Okay. So, both NSE and BSE operate fully electronic order driven trading platforms, offering seamless access to the investors across the nation. And we as well talked about the where the investors can place various types of orders on the basis of their investment strategies. So, investors can place stop loss order, market orders, limit orders that we discussed in the last session also. The stop loss order is market order and the limitless orders. So, what is that market order? Actually, it is an instruction to the particular broker to buy or sell the shares immediately at the current market price, whatever is prevailing in the market. I want to purchase this particular share at this particular price. That is what the market order. In the limits order, we can see that we have to set the limit that I want to buy a particular share at this price, that is higher side this one, at the lower side this one. And when the share price or the market comes at that particular price, the order will met out. That is what the limit order we talked about. And the next one is stop loss order. We know that the stop loss, that means if I want to purchase a particular share at 500 and again I want to sell that particular order at 470. Okay. So, what will happen? I purchase it for 500 and I want to sell at 470. So, what will be my gain or loss? This strategy will happen in case of when the markets are declining and we are going for the short selling, then it will happen. Okay. So, these types of order can be placed, and we know that there are two types of cycles in the settlement cycle, which is known as, it is T plus 1, T plus 2, T plus 3, T plus 4, T plus 5. That is what T plus 5 days cycle was there, which is also known as rolling cycles. Now, due to the electronic systems, due to the trading platforms in electronic mode, this trading and settlement cycle is shrinked from T plus 5 to its now to T plus 1 or T plus 2. As we know that there was pre-opening section for the both the items, that is from 9 to 9:15 am, in which the orders can be placed, orders can be collected, orders can be matched before the regular trading starts, and after that the regular trading starts, and which starts at 9:15. So, normal trading hours in which the investor can trade, that ranges from 9:15 to 3:30 pm, and from the days to Monday to Friday only. Saturday is non-working day for the share markets, so you can't place orders on the Saturdays. So, if you want to place an order, you can play in the working days on from Monday to Friday and from 9:15 to 3:30. We also talked about our settlement cycles. And the settlement cycles is what? When you are purchasing the share, then your money will go from your account and the share will come to your demat account. Is whole transaction takes approx transaction day, T stands for transaction day and 1 stands for one more day. So, it is the T plus 1 cycle known as, and this has enhanced the liquidity and reduced counterparty risk, aligning Indian markets with global practices. This market is also take care of the IPO, and it also can be said as that it is an market for the IPO, That means IPOs, that is initial public offers, are bring in this particular market, share markets. So, IPO market in India experienced a boom in the year 2023 with 179 IPOs launched during the year in the Indian stock markets, approx 179. Okay. So, these IPOs were launched and India seen a boom stage of IPO market. And these 179 IPO collectively raised over 55,000 crores, which is equivalent to around 6.6 billion US dollars. That is what the performance of Indian stock exchange in the last year. And some of the most notable IPOs during this year are included of Zomato. Zomato also came up with their IPO, and Tata Technologies, that is Tata Technologies, Tata bring their IPO of the company which is known as Tata Technologies, which are the major fundraisers IPOs. And Geo Financial Service, Geo also came up with this IPO named as Geo Financial Services. So, these surge in IPO activities, or this what we can say high movements, or this particular growth in the IPO activities reflects increasing investor appetite for new companies, especially in the sectors like technical or technology, financial services and renewable energy. It also demonstrates the deepening of capital markets as more businesses seeks for equity financing. That is why the IPOs were booming in the particular year and lead to the great success. Now, coming to the trends and future outlooks. What are the emerging trends and what are the going trends and what is the future outlook of this particular markets. So, as we look ahead, several emerging trends are shaping the future of India's stock markets. Like, what are these trends? These trends are something like algorithm tradings, use of AI in the stock markets, and these trends shows that there is a clear increase in retail participation driven by proliferation of online trading apps and low cost brokerages. Why these are happening? It is due to the low cost brokerage houses and online trading apps, due to which the trading surge increased in the retail investments also. And we also talked about the adoption of algorithm trading. High frequency trading is growing, but these algorithm tradings are actually not catching up the markets, but it is a tool for the purpose of earning the more return, and especially for the institutional investors. Okay. So, we can say that there is significant shift is underway, that due to these technologies, due to this enabled, what we can say, electronic enabled platforms towards sustainable and ESG investing or ESG compliance investing, with investors showing preference for companies that scores well on environmental, social and governance metrics. So, it is also a future trend which is undergoing, that means companies are complying for the ESG metrics also. So, however, investors must remain cautious of the potential risks due to the stock markets or the trading in the stock market, and these potential risks are what we can say, risk due to the fluctuations, risk due to a global economic slowdown which we seen in the last few years, where the economic inflation was there, sorry, not inflation, deflation was there. It can be due to geopolitical uncertainties, that can be war, that can be natural disasters, and domestic inflationary pressures. Domestic inflationary pressures like in economic pressures or the inflation economic, these all. So, balancing optimism with risk awareness will be the key for the purpose of investors. That is what about the today's session. Thank you for the today's session.